Great to have you with us on this Wednesday. The main focal point for the markets today is a decision on interest rates in the United States. The U.S. Federal Reserve is expected to hold rates steady for a third straight meeting. Of course, those rates are already sitting at a 22-year high and have prompted questions about how long that is warranted if inflation pressures are easing. Here in Canada, some have argued the stakes surrounding higher rates are higher, as we have seen more signs of a cooling economy, and there are growing expectations that rates will come down next year. But getting back to the Fed, there could be some pushback against the market's growing belief that U.S. cuts are coming soon. Note that growing belief in the market has helped to lift riskier assets in recent weeks. But the Fed Chair Jay Powell has previously emphasized a desire to evaluate the impact of higher borrowing costs before signaling any cuts. Note that after the Fed's decision today at 2 o'clock Eastern time, there will be a press conference with Powell, so we'll expect lots of messaging to chew on. Let's set the table and kick off our coverage this hour with Karl Schamotta, Chief Market Strategist at Corpay. Karl, nice to see you.
You as well.
Okay, what are you watching for today?
Right. So we're expecting three things, basically. Obviously, we're going to see the Fed keep the target for the Fed funds rate between 5.25 and 5.5 in the statement itself. We expect a small dovish pivot in that statement where they remove a sentence that previously pointed to additional policy firming. They're very likely to pull that out, given that they and the markets do not expect to raise rates again in this cycle. In the statement for economic projections, or the dot plot, we would expect the policymakers sort of to converge with where the markets are to some degree. So to kind of meet them halfway, right? So in September, they said that they would cut by roughly 50 basis points next year. We expect them to say 75 basis points in this particular iteration. Now, markets are priced for 110 basis points, so it's not quite as, as ebullient as what markets are looking for, but it does, definitely acknowledge that that disinflation is happening in the U.S. economy, that growth is cooling, and that it makes sense to, move off those highly restrictive policy settings that we've seen up to this point. And then after all that, then we would expect Powell to come in and try to make that hawkish argument that he has been making in recent meetings, simply so that he avoid sort of a premature, unwarranted, disorderly loosening in financial conditions, right? He doesn't want to see the markets undoing all of the work that the Fed has done so far in tightening policy.
I appreciate you trying to put that all together, because I wrote down a few words while you were talking. Small dovish pivot, and then a return to hawkish language to summarize it all up. I mean, what is going on right now? Is this really about the economy? Is it as much about trying to balance the market's expectations, which you alluded to? What's going on?
It is about the economy. I think they are reading what they're seeing in the economy. I would argue that we're sort of at an interesting juncture here. We're all talking about soft landing this, soft landing that.
Yeah.
I would say we probably already had our soft landing. We're probably there right now. Inflation is very, very close to target.
You're talking about the U.S. specifically?
Yes,
or?
the U.S. So
okay.
yeah, Canada's very different.
We'll talk about that.
But yeah, in the U.S. we have inflation coming down, very, very close to target. Certainly within the Fed's comfort zone to some degree. Unemployment is not spiking to any huge degree. Growth is still topping forecasts. That would suggest that, what they were trying to achieve when they began this tightening cycle has been achieved. Now, the question is, does the plane hit the control tower on the way out, right? Like, are we going to see worse consequences next year? And I think the Fed markets, we're all preparing for that to happen, right? For further downside to occur, for inflation to remain quiescent, and for the economy to slow more dramatically.
I feel I got to seek out an economist who has experience as an air traffic controller as well. If that person exists in the world, they would be a great person to interview.
And very frazzled. I believe that that's a very stressful occupation. When you get things wrong, you're in very big trouble. Whereas an economist gets to get it wrong routinely for years and years, and we still get invited back.
That's right. Well, we need to fill programming hours here. I know we want to get to the Canadian economy in just a second, but we live next to this elephant, and we've come into the last couple of years asking a lot of questions around where the economy is headed. And you talked about maybe things have actually worked out relatively well for the U.S. economy. So I guess I'll come back to the fact that because there have been growing expectations, and heck, this hour we're going to talk to a stock market strategist who's quite bullish on the rally continuing. Is there a danger here that if the economy actually doesn't see, and I'm talking more about the U.S., a collapse, that some of what we've seen recently ultimately does reverse because the fight against inflation's not over and the Fed feels they just don't have to make a move on rates as aggressively as the market might expect?
Oh, quite possible.
Okay, so a big possibility.
I'd kind of point to two things, right? So firstly, obviously we've seen this massive loosening in financial conditions.
Yeah.
I saw something on Twitter this morning where someone pointed out that the gain in the S&P is the biggest between meetings, so between the September meeting and today, than any meeting since 2008. Right.
I mean, we're up 13% for the S&P, I think, since late October.
Right. So if you look at like the net, gain between those two meetings, you're looking at a huge gain relative to past history, right? And so you have that, but you also have. So I follow a thing called the New Sentiment Index published by the San Francisco Fed, and basically what they're measuring is the level of positivity that we're seeing in coverage of the economy, and that has turned into positive territory in recent weeks, and so this is a huge shift given where we were, over the last couple of years. The vibe session is essentially over. People are now telling very positive stories about the economy. That creates the conditions for a melt-up that eventually does translate into more demand and more inflation pressure.
Okay.
I think that could all be very ill-founded, given the fact that we still haven't seen those monetary lags actually hit the real economy. And we know that further damage is coming and that damage has been done already. So where we could wind up in a lot of volatility early next year is where that very good news story at sort of the top level runs right into a worsening picture from a fundamental perspective.
Well, in our remaining time, I want to compare it to the Canadian situation because Stephen Poloz, the former Bank of Canada governor, said yesterday, he was talking to Amber Canwar about the fact that he just doesn't feel like the full impact of those higher rates has been felt by our economy yet. So, maybe there are lingering inflationary pressures, but here's a former central banker saying there's lingering interest rate risk from these higher interest rates.
I would absolutely agree with him. At the end of the day, the Canadian economy came into this in a far more sensitive position with far higher debt levels. We know that damage is going to be spread over multiple years, even if rates begin to kind of come down a bit, because rates are so much higher than they were prior to the pandemic. So a consumption crunch is underway already. Arguably, we might be on the edge of a recession. And early next year, that is expected to continue dragging on the loonie.
So what is the market saying about interest rate policy in Canada versus the U.S. next year, in your opinion?
Fairly convergent, which is a big difference from where we were a couple months ago. Now the Bank of Canada is expected basically to keep pace with the Fed. So we're not seeing that big mismatch in pricing that we had seen prior. What I would think that one delta or area of uncertainty is whether next year we begin to see Bank of Canada cuts pulling away from the Fed. In other words, people expecting the Bank of Canada to cut more aggressively than the Fed, which is not typical of past patterns, but it is representative of the fundamentals in the Canadian economy relative to the U.S.
And they would do if we saw a lot of signs of a divergent economy on paper.
That's right. Rates traders do trade it that way.
Yeah.
The question is that, historically, when the U.S. economy does well, we do tend to pull out a bit here in Canada. We do tend to see a floor being put under the Canadian economy. And that's where I think there's a huge wild card here, right? We're looking at fundamentals in the Canadian economy. Those do not look positive. But at the same time, if we do see the U.S. powering the global economy ahead,
we can ride
it's going to be very hard to buck that trend.
Okay.
Yeah.
Really good